Good morning, everybody. So my name is Marc O'Sullivan. I'm the head of investments at Wesleyan, but for the intents and purposes of this presentation, I'm the fund manager of the With Profits Fund. I've been at Wesleyan since June 2003, so 20 years of experience in financial markets. For the next sort of 30, 40 minutes, what I'll try and do is just give you a feel for how the team's set up, what our investment beliefs are. I'll touch on sustainable investing because that is a lens that we use to run the fund. And then I'll try and walk you through the individual asset classes that make up the fund and how we think about markets, especially as long-term investors, what we think will happen over the short, medium and long term as well. So if we just talk about our investment beliefs, so this is what underpins our approach to investing, and it's all in-house expertise. So we've got a slide on the individual team members, but we've got a set of beliefs that we really anchor to. And the first one is probably the most important, and it overarches all of the other ones really, and that's that we think sustainable and responsible investing. And then the next bit's the key part, and attractive valuations. And the reason why we think that's important is that we know there's a lot of good companies out there doing the right thing, but if we can't get the valuation piece to hook up, it's a very difficult sell to lose money and say, look, we were in good companies, but from a returns perspective, it didn't deliver. So we're trying to marry up those two real key themes around looking for those companies that will be here for the long term, but will deliver long-term returns. And that's because we think the valuation that we're investing in is attractive. And that's why we think it can deliver competitive long-term returns. And beneath that, we're long-term investors. So that just goes hand in hand with that. We're not just flipping the portfolio dramatically from one quarter to the next. So that's a lower turnover. So we won't, shift dramatically out of particular names because we're trying to sow long-term seeds. It's a balanced fund, so it's in the moderate space. So we're very well diversified. So as much as we're positioned in sort of 70% plus what we call real assets, we're diversified by geography and by sector. What we don't want to do is take a really concentrated bet and not be apologetic because it didn't pay off. Something will always go wrong within a portfolio. If somebody tells you otherwise, I think they're probably lying to you. We're active managers, and we've got a contra-cyclical overlay as well. So we're looking to invest when we think things are temporarily out of favour. So find a good long-term company and actually try and pick and choose when the best time to invest is. And quite often that leads to us harvesting profits when we think markets are a bit toppy, and then doing the opposite when we think there's a dislocation or a bit of stress in markets, and that's typically when we'll be putting money back into markets. And that conveyor belt approach we think just adds value over the long term. We're conscientious stewards of the assets entrusted to us. So again, we're direct investors. We've got a team that help us around sustainable investing. But that also means that we vote at AGM, so we're holding the companies to account. So if we think their remuneration policies are egregious, then we'll be saying, look, no, it's too much. We're there with shareholders and we've got a voice. And then finally, brings it all together. So it's trying to maximise total returns. It's through fundamental analysis. So we've got a team of analysts. We've got people out there doing due diligence, meeting companies, attending conferences. So we're generating the ideas that we're putting into the portfolios. I should say, actually, if there's any questions, please, I'm happy for this to be as interactive as possible. There's no silly questions when it comes to investing. So this is the team. It's headed up by Martin Lawrence in a minute. Top middle, and then towards the left-hand side, it's myself with a team of fund managers. So we're talking about the With Profits Fund, but we do manage over £7 billion worth of assets. So we've got unit trust business, we've got unit things, we've got pension business. So it's a big team. There's no single point of dependency or key person. It's very much a team effort. So we've got experience throughout the team. So I've been here for 20 years, Martin's been here for 25 years, Paul Burton's worked in fixed income for 30 years, Caroline 20 years. So we've got a team that's really seen all of the sort of the flows and outs that you'll see in markets, and particularly when we're going through so many geopolitical events and so many, we've had everything from wars, pandemics, referendums, global financial crisis. It feels like all of the events that we think are 1 in 200 year events are almost happening, coming through the stage within a decade or two. But just working around perhaps clockwise, we've got Joe Curler, who heads up an in-house property team. So we've got commercial property assets that Joe heads up. We've got a support team that help us with comms. We've got Lucas, who heads up sustainable investing. So that's the sort of 6 o'clock. piece, and then we've got a research function. So those are where the ideas are being generated. But again, it's a team effort. All of these sorts of conversations and individual silos are just brought back in a weekly meeting where we share the ideas around. It's always good to have external recognition. We must be doing something right. So these are just some of the awards that we've won over the last few years. So really pleasing to see that as well. I'll touch on sustainable investing. I've only got a single slide on this. I know this is probably more important for some delivers, but we do have a landing page on our direct.co.uk site. So if it's something that you want to delve in a little bit more, there's a lot more literature behind it. So I'm just mindful of time. But the approach we take is a three-pillar approach. So reducing harm, positive impact, and driving change. Now, we arrived at this through some pragmatic consultation with existing investors within the fund, just to see, what our client base really thinks and feels, and where do we feel strongly on particular topics. And unsurprisingly, sustainable investing in ESG isn't as black and white. Quite often, as people make it out to believe. So we've got some key things that we don't invest in. So, for example, tobacco companies. There are no tobacco companies within the portfolio. We do hold some energy companies, and some that we don't. And the bar that we set ourselves is that, one, they have to align to be carbon net zero by 2050. But also they have to go more than that. They have to walk the walk. There are some companies that say that, but in terms of their capex and what they're buying, they don't necessarily show that they're aligning to that. So it's very easy to say, but 2050 is still a way away. You could hand that off to the next chief exec, or it could be somebody else's problem. So we've got some companies, energy companies in the US, for example, that don't seem to show us that behaviour, so we don't invest in those. But we do hold some companies in Europe and the UK where it's not only said that they're aligned to carbon net zero 2050, they're actually demonstrating it by buying acreage in the North Sea and putting wind farms on. That's the sort of transition that we're expecting these energy companies to be on. And that aligns to the sustainable and responsible part again, because those energy companies aren't going away. If anything, they might spearhead the transition by using the profits that they're making today from carbon-intensive industries to redeploy and buy those acreage and put wind farm and battery storage down to the next part of their development. This is a very busy slide, but I'll only really talk to the four gold boxes just to give you a feel for how we operate within the department. So we'll screen and monitor a big universe of investment opportunities. We'll start to do the fundamental analysis then. That's looking through the cash flow, the balance sheet, the income statements. We engage with the companies. It's always good to see the whites of the eyes of the management team, and that's attending conferences. And we bring it all together in that valuation and debate part. And that goes back to that overarching belief I said at the start. If the valuation doesn't stack up, it'll be a very good company. We like the management team, we like what they do. We'll probably put it on the subs bench until the valuation either comes down to a level that we think is attractive. So continuous cycle of events there. That's just part of that conveyor belt approach within the department. So switching now to investment markets. Those are the four main building blocks that we use, that we grade through this risk reward thermometer. So unsurprisingly, cash at the bottom, going through gilts, corporate bonds, and then into property and equities. So those, I'll talk to each one individually across the coming slides, but that's how the fund, uses various asset classes. So as much as we'll say we're pro real assets, which in our eyes are equities and property, it is a balanced fund, so we do need to have government bonds, cash, and corporate bonds within there as well. So how's the fund positioned? And this, it's if we take the property section of the donut chart and the equities, we're unashamedly pro-growth. We just think, this goes all the way back to the 1800s. There's a wealth of, literature, research that just shows you that equities and properties will outperform some of those fixed income and cash assets for long-term investors. So we've positioned the portfolio accordingly, and as we stand here today, we still think that holds true. But it's a balanced fund, so we do have some fixed interest assets within there as well as cash, so about 5% cash. which is always useful for that dry period. That if something does happen, if there is a setback in the markets, then we can deploy it. So global inflation, I mean, this has really been the story of the last few years. As you can see, this is a sort of 10-year chart. Most major inflation rates across the globe in that sort of 0 to 4%, give or take, for quite a while. We went into COVID lockdowns, we reopened, people went out and spent their accumulated savings. We had the invasion of Ukraine by Russia, which jerked gas prices high, and we had this combined effect that really sent global inflation rates much higher. UK, which is the goal line, takes the wooden spoon for hitting 11% plus inflation rate. Well, we've turned the corner, and as the chart hopefully illustrates, the downward trajectory is set. Inflation rates are coming down at a reasonable clip. The conversation now is whether have we got them back to the 2% level that central banks are targeted with, or are we down into a sort of a 2, 3, 4% range? Because that will have all sorts of consequences for what central banks do. It's just 2% drop. Well, I mean, that's a valid point. I think central banks will always probably try and put a number out there, because if it's not 2, is it 3, and there's 3 creep to 4. So they're always mindful of the damage that excessive inflation can lead to, and deflation is probably something they can't entertain because debt levels are just too high across the globe. I suspect central banks will secretly probably prefer a little bit more inflation, just because you can monetize the debt piles a little bit more. But saying that, when the politicians say 2% is that Goldilocks number, then that's it. Job security, I guess, is what it comes down to from the central bank. But the point we'll probably touch on is almost we're starting to see just a little bit of an inflection. So we're getting very close to 2%, but all of a sudden, markets and animal spirits seem to be rekindled. We've still got relatively full employment. People are still out there spending. So are we going to bounce off 2%? And if we do, does that make it harder for central banks to cut interest rates, which is where, as we stand today, markets are expecting quite a sequence of cuts to happen over the next 12 months. So will markets be disappointed? And at the moment, we probably think they've lurched too far in that direction. We think that we probably are going to get to a much better place in terms of getting inflation under control, but it feels like markets are expecting far too much in terms of interest rate cuts. And we think there's a possible disappointment. Just a quick one on the UK CPI. The CPI line itself is the dark grey line, but we can split it out into goods and services. And goods, as you can see, far more erratic, far much more spiky. And you can see when we were short of goods, shipping rates were through the roof, energy prices were going up. Companies didn't miss the opportunity to push goods prices up to almost 15%. And goods prices are really coming down at quite a clip at the moment, but it's almost the turquoise line, which is more interesting, and that's services, because that's far steadier. It's later to turn up, and arguably it's later to come back down to trend, and that's where central banks are starting to look to do a service-based economies, as most Western countries are. Is it just going to take a little bit longer for those numbers to come back down in the service economy, especially when people post-COVID lockdown are still keen to get out there and return to normality and carry on, consuming services. So we're mindful that as much as goods inflation prices have come back down, is there still perhaps something just lingering in the system, which goes back to this point around, will we find it more difficult to break back, for a sustained period below that 2% level? I mean, quite interesting. When we look at the ONS data, who produce the CPI basket of goods in the UK, we actually think the UK, even though it took the wooden spoon for hitting 11%, might actually be one of the first countries. We think probably by perhaps May, June, might break the 2% level before Europe and before the US. And the UK is very particular because we've got the off-gen price tariffs and a lot of things that will drop out. But it's an interesting anecdote in terms of the UK could be the poster child for have the worst inflation, but perhaps the first one to get back in the target for a period. bit of a noisy chart, but this is the UK bank rate, so the MPC rate. What I'm trying to show here is that the financial markets lead to one conclusion and then they lead to another. So the first line's probably just call out is the red dotted line because that's the policy rate as we stand today, 5.25%. The other three lines are just 3 periods of time where financial markets have tried to predict where those interest rates would go over 60 months. The bottom axis, the x-axis, so it's 5 years. And it's just to show that 6 months ago, which is the turquoise line, we actually thought Bank of England would go up to almost 6.5%. We didn't get anywhere near that. But a year ago, we didn't think we'd get much above 4.5%, which is the grey line. So it's just to show that we overshoot and we undershoot. And the gold line is the interesting one because that's where expectations sit today. And you can see that there's a steady path there in sequential rate cuts that are expected, and almost, if we take the 10 as the proxy for the year, 12 months, we're almost expecting to be about 4% within a year. That's where we think there's perhaps a little bit of scope for disappointment because as much as inflation's on the way down, we're a little bit apprehensive that central banks want to quickly pivot, open up financial taps again in terms of monetary policy, taking the foot off the pedal at a point where we might still see some lingering inflation in the system. So we think it'll probably take a little bit longer than markets are currently anticipating. This is the 10-year gilt yield, just to show quite a round trip here. So we're just working through the asset classes. So again, that's on where cash rates are. This is moving into government bond territory. We've long been scratching our heads around the yields available in government bonds. It's one of the reasons why we held more equity in the fund. We just didn't see attractive valuation levels in government bonds for long-term investors who are coming to right. We've obviously had quite a big spike of late. Central banks have moved their interest rates higher, and that for us presented far better entry point to start to put money into the funds, in particular picking up some of those government bonds. And I'll give you a case study on that in terms of the activity that we've been working to. And this is it. So this is a 30-year government bond yield. So coming into this, looking at some of the more recent years when 30-year government bond was delivering somewhere between 0 and 2%. So that's, that's averaging out. So it's 1% return each and every year for the next 30 years if you bought that government bond and held it for the next 30 years. Then with inflation targeted at 2, that just doesn't strike us as value as sort of contracyclical and value-minded investors. Because if inflation averages 2, which is the target, and you're getting a nominal 1% return, you're not even keeping pace with inflation. So what I'm trying to illustrate here is that we didn't buy any government bonds in that period. We were almost, sat under the hands looking at it. So kind of, look, we're happy with our equities, thank you very much. But then along came inflation. Coupled with that, I've called out the mini budget debacle. Then we had liability-driven investment, which is the LDI crisis, where we got real spikes higher in those government bonds. So I'd be hypocritical if I say we were doing nothing when the rates were 1-2%, but all of a sudden we're getting much closer to 5%. So yes, inflation was very high, but remember we're talking about 5% each and every year for the next 30 years. So within that 30-year period, we're expecting inflation to come back down from the elevated levels. So if it did average, or if it does average 2% over 30 years, we've got 3% over and above that locked in, and that's quite attractive as investors that were underweight bonds and short duration. And then we got the Bank of England stepped in following liability driving the LDI sell-off, and we came all the way back down. We thought we missed our opportunity, but then the inflation print remained stubborn, and markets continued to push yields back up. And we made a sequence of purchases all the way through between that 4 and 5% corridor. So it's just to give you an example of where, if the valuation doesn't strike us as attractive, we're doing nothing, or we're allocating assets to other parts of the portfolio. If all of a sudden the markets move quite dramatically and present us with a good opportunity, but let's be clear that the moves that we're seeing here is a long-term duration, long duration assets, these bonds fell with sort of 50%, give or take. So as much as we're talking about the interest rate or the yield to investors move from 1 to 5%, that's really dramatic for long-term cash flows 30 years into the future. So these to us were assets that would all of a sudden halved in value. This is moving up, so this is corporate bonds. So in our view, the UK government can't really go bust because you can just bring cans until the cans come home. Companies can go bust. So these are PLCs effectively, or corporations. And what you want as an investor is a premium over and above the government bond return to reflect the risk that those companies can go bust. And what we've called out here some investment grade, AA, single A, and triple B spread. So these are the returns over and above the UK government 10-year bond, which is about 4% as we sit here today. So effectively saying that if the red line, which is triple B corporate bonds, that's 150 basis points, so that's about 5.5%. So it's that 4% government bonds with about another 1.5% seems to go on some top. So what we're trying to illustrate here is that there's opportunities. You really want to be buying in those spiky periods, but quite often those spiky periods are when the world's ending, so that's the COVID spike. We've got the LDI and budget issues there. But when we were buying in those periods, so we were buying not only the UK government bonds, we were buying corporate paper as well, and picking up yields on some of those assets in the sort of 7 to 8% territory. Now, for us, that's an equity-like return, and the corporate bond sits, higher up the capital stack. Equities, effectively, if a company goes bust, the first thing that goes is the equity. So you will gain an equity-like return, but in the debt portion of the capital stack. So again, some really good opportunities there. So active managers, that's what we're there doing as part of the day job, looking for those opportunities or when the markets start to present something interesting for us. So that's corporate bonds. We'll just touch on property. So it's just zooms in on Joe and his team. So we've got about £400 million worth of property assets, and this is give or take, it's even simple for that. £4 billion fund, so just under 10% of the fund in property. Within that, we get an income of about 30 million. So 30 million over your 400 million is about 7.5% rental income. And property is quite an capital intensive exercise. We have to keep properties in reasonable shape. So we lose about a percentage point of cost within that 7.5%. But that still comes back to a 6.5% rental income. So I'm just trying to take you through the blocks. And if the 10-year government bond is 4.5%, we've got corporate bonds that are delivering, let's say, 5.5%, 6%, and we've got property that's saying that we could deliver, about 6.5% rental income, and we'll get capital growth hopefully over that as well. Just trying to, position why the fund is where it is, and why the asset classes and the valuation levels are telling us to, position the portfolio in a particular way. Just a few shots of the types of assets in there. So, retail gaps, back person, the high street style. So it is all about that location phrase. So joining the team, when it comes to something like retail, is looking for winning town cities, strong demographics, tourist footfall, Winchester, Cheltenham, Salisbury. We've put a furniture village into Tunbridge Wells because out of tech retail has actually been one of the areas that's benefited from COVID. So with remote working and hybrid, footfall has dropped off in big cities and conurbations, but probably the areas that have won are those sort of out-of-town retail parks a little bit closer to home that people are using more often. So that's an area that we've been adding to the portfolio, and that tailwind of hybrid working and flexible working has played well because some of those assets are doing very well. We're moving to equities now, and this hopefully illustrates our in terms of short-term and long-term investing. So this is the S&P 500, which is the biggest 500 companies in the US. There's a lot of data and history behind this. And on the left-hand side, the one that looks a bit like Jackson Pollock is just looking at price earnings ratio, which is the red line at the bottom, which is just the US P valuation, is just under 20 times. But what does that mean? So we've put a load of dots on there to say if the starting point valuation for the US is about 20 times, what can happen over the next 12 months? And it's akin to a random walk. There have been instances where the S&P's fallen almost 20% in the next 12 months, and there have been instances where it's risen by almost 30%. So it's very difficult to predict what can happen over a 12-month period. What I've then done on the chart on the right is I've taken the same starting point and just regressed it for a 10-year horizon. So what happens over the next 10 years? And as you can see, it's a much stronger linear relationship. And it's not unsurprising because the higher the number at the bottom, the more expensive the market. So if the S&P is 24, 25, 26 times, then on average over the next 10 years, you're probably going to lose money. And similarly, when the number becomes smaller, you're actually going to make money. So it comes back, and a lot of these points will coincide with things like the top of the TMT bubble. So if you were buying there, then you've lost money. And a lot of the numbers, where you're getting really chunky returns, and that's sort of 15 to 20% territory, and that's each and every year for the next 10 years, will coincide with the lows of the global financial crisis, COVID. So for us, it just proves that concept that, as value-driven long-term investors, if you can be active in and around those points where the market is either distressed or dislocated, and there'll be reasons why that's the case, but if you're brave and you hold your nerve for the long term, you will be rewarded with long-term investing. And it takes a strong constitution to do that, but I think, we've always had either capital backing, the discipline, the financial strength to do it, rather than be anchored to what we think could be a 50-50 call in any 12-month period. Similarly, we can run the same thing for the UK stock market. Again, it's probably even more random in terms of what happens over 12 months, a stronger relationship in the UK, but it's just to show these are the sorts of valuation tools and metrics that we have at our disposal to make calls around, well, if we like equities, then which equities within that equity portfolio, and we can run the same sorts of screens and valuation techniques across multiple geographies, sectors even. This just shows regional equity valuations. So it's a bit of a busy chart, but what we're trying to show here is that the US, at the moment, probably screens as the most expensive stock market. Now, this, for those that read around the financial press, there's a lot of noise around the Magnificent Seven and generative AI, and real strength in a handful of companies that drive that valuation higher. So as much as at an aggregate level the US looks expensive, we actually think there's some still really good opportunities within them. Touch on perhaps a few of the names. And most of the other global markets actually still look relatively well valued. There's still good opportunities there. So that suite of available opportunities is still ripe for picking, and we've still got plenty of ideas that myself and the team are working on. Just a case study. So this is a UK company that you may be familiar with, HomeServe. You may have seen that sort of little red with HomeServe and glazing on the side, they do everything from sort of drainage, plumbing activities. And I just wanted to take you on the journey of a company that done very well for us, but it's quite a checkered history. So HomeServe was there, says that quarter in the early 90s, got off to a great start. Shares went from effectively, tens of pence, all the way up to £4. Then, in the middle of sort of 2012, I think it was, they ran into some issues with their outbound call centres and scripts, and the FCA were uncomfortable with around the language used. It felt, as if customers were getting the tough end of the stick, and there was regulatory oversight, and the shares came off quite dramatically. And we had the chief executive in because, at that point we were one of the largest shareholders, and we backed the company to remediate it, work through the issues. And again, as long-term investors, we held on to the shares at that point. So it was very difficult. But as you can see, what then happened over the next sort of lifted and dropped the business model, took it to Europe, US, and the company went almost parabolic with growth. And as you can see, you know, kind of went all the way up to £14 almost, and we were trimming our shareholdings at that point. It moved into almost a top 10 holding within the fund. Shares have run very well. The valuation was probably at the expensive end, so we were trimming the shares. COVID came along and pretty much everything sold off, but they bounced back quite quickly once we got to the vaccine rollout stage, got back above £13, we sold again. Then there were concerns that the company was growth because it tapped into all of these overseas markets, but where's the next leg of growth coming from? The market sold the company off quite dramatically, and then at the back end of 22, Brookfield Asset Management took the company out for sort of £12. So it's really trying to illustrate that there's always volatility associated with equities, that there will be issues all the way through. But from inception to when that company was taken over, it's almost a 32-year period. If you compare the annual growth rates, akin to a sort of 13% return each and every year for that journey. But again, it does come with, you know, the Holy Grail is looking for that nice 45-degree. Probably, but there will always be ups and downs on the journey. So I'm just really trying to drive home that long-term emphasis. Where are we seeing opportunities at the moment? So as much as we talked about the strength of particular names in the US and around technology, what we've seen over the last 2 years is a real weakness come through in a lot of well-known consumer names. And that's where we think there's some interesting opportunities. So we've got the team working away on, you know, where we think the real opportunities are within this space. But I just wanted to call out some, you know, pretty well-known household names, where, you know, Adidas, Estée Lauder, Nestle, Nike, Puma, even Disney. These are all rebased to 100. So we've got Nestle down effectively 20%. We've got the likes of Estée Lauder, Puma down almost 50, 60%. So these are companies that have got issues at the moment. But do we think they'll be here in the next 10, 20, 30 years? Absolutely. It's all about, you know, does the valuation piece start to hook up, and do we start to sow these as the next seeds in the portfolio that we think temporarily out of favour, which is what markets do, and that's where we think there's some really good opportunities still to come. A bit of a busy chart, but this is just to bring all of those individual asset classes into one chart that reflects where we think the return proposition is within the portfolio. So, for example, the dark blue line is the UK government 10-year bonds, which is close to 4%. So that's saying for the next 10 years, if you buy that asset, you'll get a 4% nominal return if you hold it to maturity. After that, you're moving up the risk scale. So all of the other assets, we're trying to illustrate what returns are available on there. Then the next three lines that come are corporate bonds, which are in that sort of 4.5 to 5.5, 6% territory. But the areas that still look the most attractive are the smooth grey line, which is property, and then the other lines are effectively equity. So we still think the best place to be is in that real asset space, because that's when you can attract returns in the mid to high single-digit returns, which leads us back to how the portfolio is positioned. So as we sit here today, we still think that is the best place to be, and the portfolio reflects that. So the key takeaways, so inflation, it is on the downward trajectory. The chart shows that. It's all about, do we break down from 2% and back to that sort of 0 to 2%, or do we think that inflation may linger and there's still some issues there, which is where we're leaning. In the short term, labour markets are full. It's incredible how we've come out of this, and, you know, without any real job losses or company closures. We've also got the biggest election year in history for 2024. Millions of people voting, whether it's India, which is huge, you know, the largest population in the world. We've got the US presidential election, European elections, likely to have our own election. We're already starting to see those stories now about tax splits and giveaways, which is typically the lever that politicians pull to try and grease the wheels into those elections. And all of that could lead to more disposable income, and again, it just flips that perhaps tailing behind inflation to just move a little bit higher again if politicians are trying to make sure that everybody's in good shape. In the long run, reasons why inflation might persist, we've got a supply chain. So a lot of geopolitics at the moment, people are trying to move their supply chains away from China, which has historically been the cheapest place for production facilities. But as you start to bring them a little bit closer to home, then you're far more likely to pay more to build that factory, pay more wage and states and unions. And that could also sort of transpire to give a little bit more power to employees in that wage bargaining agreement. It just means it's a little bit more difficult to continue that sort of goods deflation story. Within that, we've got aging demographics. So labour supply is still tight. The household formation, families just aren't birth rates aren't where they used to be. So there's a lot within that might just keep inflation at the upper end. Geopolitical risks. So the news at the moment isn't great. So shipping routes under pressure in and around the Middle East. So all of those are just little sensitivities around the globe that might mean we've just got inflation issues to consider. One of the reasons why we don't think interest rates go back to that zero don't either. So more attractive opportunities in fixed income, but still not high enough to deter us from positioning in those equities and property assets. We are moving more overseas as well. That's a feature of the portfolio. It's a big world out there, so we're starting to diversify the ideas. That's what we're trying to call out on that consumer chart, just to say, look, some really good opportunities in household names. So as long as the valuation piece is there for us, then those are the sorts of areas that we'll start to look for the next opportunities. And with economics and geopolitics, just volatility is just there to stay. It's one of the reasons why smooth product and the overlay, amongst all of that, is crucial to this whole proposition from itself. Okay, I think that's me. So, any questions, or hand over to Gemma to talk to you about the smoothing piece?
That's a question about the UK recession. Given that they've got brakes on the economy at the moment and the interest rates are not coming down, do you see a recession?
Yeah, it's a great question. And apologies if you know this already, but the definition of a recession is 2 quarters of contraction. Now, if that contraction is a negative 0.1%, it's akin to a glancing blow. For us, it wouldn't really move the needle in terms of that versus something a little bit more sinister. We were already seeing Germany in recession, which is sort of the industrial heartland of Europe. But it will still muddle through. So I think we're definitely in that lower growth part of the conversation. We don't see anything that would manifest itself in a much bigger downturn. And as things stand, it's just we've got relatively full employment. I agree, we've still got things to work through, whether it be people still remortgaging, but we're already starting to hear that mortgage providers, for example, are starting to get into the next wave of competition around cutting mortgage rates. So it's on the watch list, but I don't think it's anything that concerns us as things stand. We would almost argue that we're surprised how we've got this far with interest rates having moved so far from zero unscathed. We were actually probably expecting higher unemployment in places, higher rates of business failure. And wherever we look around the globe, we've probably done incredibly well, given where interest rates have gone, to come out and scale. There's definitely inertia in there, because people with 2-year fixes, 5-year fixes haven't really hit those sorts of conversations around some have, but it's definitely a phased effect. But what's interesting now is that we almost recalibrating down those interest rates when people remortgage, that perhaps not as bad. The position's not as bad as when we were entertaining the sort of 6-7% mortgage rate conversations. So we're watching it, but I think as things stand, could it be a technical recession? Yes. There's another 2-quarter definition. But could it be very light in terms of a minus 0.1% contraction? That's the way it looks at the moment.
So I've been at Wesleyan for 11 years, it'll be 12 years this year, doing various jobs in the actuarial and finance space. The reason I'm here to talk to you today is all to do with our smoothing mechanism on our with profits. I was involved in the project to put our with profits fund out onto platforms so that it's available to use for IFAs. So today we're going to have a bit of a journey through the ages of with profits in smoothing. Might be a recap for some people, might be new for others. So I'm going to start off with what is smoothing. So this picture here, we have it on a lot of our literature, it's on our website as well. We think it's very clear for our customers as to what is the point of smoothing. It's all about reduction of volatility. As you can see here, in the good times, we're not passing on quite all of the return. We hold a bit back, and then that means we can cushion the blow in the worst times. So smoothing doesn't have to be with profits. You can get a smooth management as well, but it does fit hand in hand with profits. And with Wesleyan being a mutual, with profits suits us. We've been in the with profits business for over a century now. And we've been in it for the full time. So back in the beginning, this was a century ago, Peaky Blinders type of time, the Industrial Revolution, Wesleyan started selling with profits policies, mostly whole of life conventional policies. And that was to provide protection for the workers in the factories. Conventional with profits, there are kind of 3 key points that make what the payouts are. So you start off with your basic sum assured. That is a guaranteed amount. So the customer knows that is the minimum that they will get back if they pay their premiums as they're supposed to. But because it's with profits, there's potential to get additional money. If the company is doing well, they pass those profits on. And they can do that in 2 different ways. The first is reversionary bonuses, later rebranded as annual bonuses. They usually get once a year, and that increases the guarantee on the policy. There's then a second type of bonus called terminal bonus, rebranded as final bonus, because people don't like the word terminal. And this was not guaranteed. It was often paid on maturity or death, but quite often on withdrawal, you get penalised by having no final bonus. So you'd have to take those 3 key items out of it, and that's how you get your payout. Okay, so that was the original design, that was conventional with profits. And there were a couple of issues with this kind of design. So first of all, it wasn't particularly transparent. People liked the idea of a sum assured, they knew they could get that back, but they didn't necessarily understand the bonuses or year on year know what to anticipate in terms of the value of their policy. It was generally seen as a bit. And there were lots of quirky features, so no surrender values within the early years, tax implications, and bonuses just got more and more complicated. Probably I said employed more actuaries. Started off with simple, we went to compound, super compound. You're getting multiple annual bonus rates, some to apply to the sum assured, some to apply to the attached bonuses. It all got very confusing and complicated. And they were also very inflexible. So because you start off with your guaranteed amount, if the customer wanted to change anything, if they wanted to extend a term, increase a premium, increase the sum assured, you then have to take that away and perform a lot of calculations. Sometimes it just wasn't allowed. Sometimes it could take up to a week to go and find someone to recalculate the value of the policy if you wanted to make a change.
Got it.
And then something else started to happen. So we hit the 90s, the 2000s, and we weren't getting the same level of returns that we were getting a century ago. And what this meant for companies that were selling conventional with profits is they built up those guarantees in the form of reversionary or annual bonuses. They'd set those thinking they were quite prudent, assuming that they were guaranteed to make at least 10% a year for all of them. And then as those returns came down, what actually happened was a lot of those guarantees started to bite. That caused a lot of people to want to come out of the market. And for people like Wesleyan who stayed in the market, it really meant getting rid of the guaranteed sum assured. So in its place came unitised with profits. The kind of standard way of doing this, we call it a shadow fund approach. So it is unitised, but because it's with profits, people thought, well, it should still have bonuses. So people can see it's with profits and they can see the bonuses that they're getting. So whilst your premium was used to purchase a number of units, like any other unit-linked fund, when you wanted to go and get the valuation of your policy, you then also have some annual bonuses and some final bonuses on top of that. So still that structure in place, but because everybody's worried that guarantee is vomiting, we saw the introduction of the MVR. The MVR is a market value reduction. And what that allows companies to do is they have the right to reduce the value of your payout. The idea here is that if there was a large market crash, to avoid paying out lots of people an amount that was higher than the value of their policy, you would apply a flat, say 10% cut, 20% cut. But what that looks like to the customer is the value of that policy would just fall that amount overnight. And it's built into the contract that companies can do that at any time. Right, so that was where we were at. That was what a lot of people were doing. The shadow fund approach, still with your bonuses, but with your MVRs. So at Wesleyan in
That's working again, man.
In around 2018, we decided to do a review of the way that our unitised with profits worked. We thought it took 70 years for the industry to make the last change. We probably should wait another 70 years. So we did lots of market research, got a lot of actuaries together in a room, lots of cups of tea, and came up with our new unitised with profits design. So we did this in sort of 2018 into 2019. This was actually quite timely because we then decided that we wanted to put our fund on the platform. And all this work that we'd already done to redesign the way that we do our with profits and therefore set us up to go onto a platform to give us something that can be put straight onto a platform. So the design, as Nick touched on earlier, is just a single unit price, single price fund. If you want to know the value of your fund, it's the number of units times the unit price. That's available daily, it's priced daily, it's smoothed daily. There are no MVRs, no annual or final bonuses. It just looks and feels like any other unit-linked fund. We've just applied a smoothing overlay. So it's a smooth unit price that you're getting on a daily basis. So we're going to dig a bit more into our smoothing and how that works. We came up with our smoothing formula. We call it a gap mapping formula. And it's concerned with two things. You've got the smooth price and the unsmooth price on any day. On any day, there will be a difference between the two. And we look at the gap between those two. Our smoothing formula, you can just think of it like an algorithm. It takes the starting gap, you put it through the smoothing formula, and it tells you what to change that down to. So that's how we set our unit price every day. The way that we came up with the algorithm, the smoothing formula, we did a lot of stress and scenario testing, millions of simulations to come up with a level of smoothing that we thought was optimal. Well, we had two kind of key aims that we wanted to address, and that was number one, when the gap is big, when the markets are volatile, we want to close it down more quickly. When the markets are stable, we want a unit price that grows at a steady rate. So we set about designing our formula and did all of our testing on it, and that's how it works on a day-to-day basis. So the unit pricing is done by the smoothing formula. 2 pairs of human eyes on it every day for control purposes, but there are no judgment calls made on a day-to-day basis. It is formulaic how we set our smooth price. So that's kind of the high level theory of it. But the interesting thing is, what does that look like in practice? So first of all, we've got these graphs here. We have taken the grey line, which is the ABI return over the period. So we're looking at ABI returns to strip out anything to do with investment performance, and this allows us to show what our smoothing formula does and then compare it to some alternatives that you might see out there. So the first one, 2014, was the most stable year that I could find, and smoothing is nice and easy when the market price is stable. Everybody does basically the same thing, just growing nice and steadily. Where things get interesting is when markets get more volatile. So we've also had a look at 2020. And there are a couple of things to draw out in this graph. So the first thing to say is that smoothing is not magic. The unit price will go down if there is a large market crash. The second thing to say, though, is it doesn't go down by as much. That's the smoothing at play. When you see the big fall there, the underlying return falls about 20%. The gold line falls about 10%. So we're using some of that gain that we've held back in the past to cushion that, and also anticipating that we'll be able to take some back in the future as well. So periods where you see the large drop, that's actually over the space of a couple of weeks. So on a day-to-day basis, the customer will be seeing that unit price, they will be seeing what happens, they can take their money out if they're not comfortable. If they are comfortable, they can stay in and ride it out. So whilst it does fall about 10%, spread over time, it's not a one-off shock. The blue line that we've got there is an alternative smoothing formula. A few people out there are doing an estimated growth rate and then a unit price adjustment. So this is just to allow us to compare the two. And as you can see, that would lead to a one-day fall, whereas Wesleyan is over the space of a couple of weeks. The next thing that happens after a market crash is a market rebound, and we start to get some great returns coming back through. Again, the thing with the Wesleyan smoothing formula, as soon as those two lines intersect, the gold line starts to go up. So the unit price starts to increase. We start passing on those profits straight away again. That's different to a unit price adjustment approach, where you need to wait for the gap to be a certain size before you close it down. But fundamentally, they're both looking at the same thing. They're both looking at the difference between the smooth and the unsmooth price. The way that you smooth is judgmental. It's down to individual people, which ones they prefer. The Wesleyan approach does close the gap down a small amount each day. The alternative, ride it out until it gets too big, don't close it. And then finally, got a nice big picture here. So that's over 10 years. That's the same thing, just so that you can see what it looks like over a longer time period. So the gold line there is the smoothing formula doing exactly what we want it to do, smoothing out a lot of the volatility in those underlying returns and giving the customer a smooth journey. So like I say, smoothing is all about the journey. If you've got money that you can invest and you know that you can wait and take it out at the most opportune moment, that's great. But quite a lot of the time, real life happens, your garage floods and you need some money, or maybe you're in income drawdown and you need to take money out from there. These are kind of key situations where smoothing can reduce the risk, so it can reduce sequencing risk as well.